Eurozone growth picks up in August but trade war casts a shadow. Survey. London. Eurozone business activity picked up a bit last month, extending a period of solid growth, but a growing global trade war kept optimism in check and suggests the pace may not be maintained, a survey showed. Signs of robust growth and inflationary pressures means the European Central Bank is unlikely to be swayed from closing its €2.6 trillion asset purchase program by year-end. IHS Markit's Eurozone Composite Final Purchasing Managers Index, seen as a good guide to economic health, nudged up in August to 54.5 from July's 54.3, just above an earlier flash estimate of 54.4. Anything above 50 indicates growth. August's surveys point to quarterly Eurozone economic growth of 0.4%, matching a forecast in Reuters poll last month, IHS Markit said. But it also questioned whether the pace could be maintained next quarter. The composite PMIs were pretty encouraging, said Jack Allen at Capital Economics. The trade war has had some effect. The policies that have been implemented so far by the U.S. hitting the Eurozone are pretty small, but worries about protectionism escalating in the future could have had an impact on businesses. An index measuring optimism sank to a near two-year low of 61.6 from 63.1. Purchasing managers were spooked about the impact of trade wars, IHS Markit said. U.S. President Donald Trump has said he is ready to implement new tariffs on Chinese imports as soon as Thursday, which would be a major escalation after Washington earlier applied tariffs on $50 billion of exports from China. Markets were little moved after the PMI surveys, instead focusing attention on the looming deadline which kept the dollar near two-week highs on Wednesday, inflicting fresh losses on emerging markets and sending world stocks lower for the fourth day in a row. Domestic help. With the trade war intensifying, German services growth was supported by a domestically driven upswing in Europe's largest economy, reaching a six-month high, and French activity also picked up, earlier surveys showed. In Britain, outside the currency bloc, and set to leave the European Union next year, its large services sector picked up more strongly than expected last month, bucking a slowdown for manufacturers and construction firms. But Brexit worries are dampening investment plans and confidence for the year ahead. Britain's economy has slowed since the June 2016 Brexit vote, its growth rate slipping from top spot among the Group of Seven group of rich nations to jostling with long-term laggards Japan and Italy for bottom place in the growth rankings. Italy's services sector slowed for a second month running in August, according to an earlier PMI. The Italian indices were a bit more interesting and a bit more worrying. The big picture is that Italy seems likely to remain laggard in the Eurozone, leaving it vulnerable to further economic shocks and possible sell-offs in the market, Allen said. Most recent data in the Eurozone's third-largest economy have pointed to a slowdown, posing a challenge for the anti-establishment government of the Five Star Movement and the right-wing League, which took office in June. A PMI covering the Eurozone's dominant service industry rose to 54.4 from 54.2, in line with a preliminary reading, but well shy of readings witnessed around the start of the year. Still, forward-looking indicators were also more positive last month, with new business and backlogs of work accelerating. An index measuring employment, which is a lagging indicator, rose to 55.3 from 54.6, its highest since October 2007. However, Eurozone retail sales grew at a more moderate rate than expected year-on-year in July, mirroring a steady weakening of consumer sentiment since the start of the year. The global trade storm is unlikely to change Asia's positive consumer story. The outlook for consumer spending in Asia remains bright despite global trade tensions, Daiwa Capital Markets says. Consumers may be forced to tighten their belts, but the overall scenario for continued growth is unlikely to change drastically given positive fundamentals. Authorities in China may be ready to step in and provide policy support to counter spending weakness, UBS says. Consumer spending in Asia, with a big push from China, is an increasingly important economic driver for the region. But with the global trade environment fragile and U.S.-China tariff conflict escalating, it remains a question whether the momentum can continue. The answer, according to some strategists, investors, and analysts, is largely that it will, though there are potential bumps in the road. The outlook for consumer spending in Asia, a region which accounts for 60% of the world's population, remains bright overall, according to a report issued Monday by Daiwa Capital Markets in Hong Kong. Optimism is buoyed by factors such as an overall relatively young and growing population, an expanding middle class, and increasing wealth. Consumption will likely be a dominant economic theme in Asia in the next few decades, underlined by population expansion and rising private incomes, wrote the report's lead author, Paul Mcgibney, Daiwa's chief equity strategist for Asia-Pacific research. Possible setbacks caused by renewed protectionist sentiment and global liquidity tightening in the near term are unlikely to derail the uptrend in Asian consumption, in our view, the report said. Corinne Hearn, partner at asset manager East Capital in Hong Kong, also said that Asia remains an attractive consumer proposition given positives such as demographics and increasing purchasing power. Hearn added that it is important to remember that even though tariffs can impact consumer prices and inflation, trade itself will continue and Asian consumer spending is likely to avoid major disruption. Policy action. Asia, in general, is quite immune to any major pain from the ongoing tariff battles, she told CNBC on Wednesday. Daiwa noted that trade risks could have some negative impact, especially if global supply chains, in which Asia plays a key role, take a significant hit. This could in turn dampen individual income growth and end consumer confidence, leading to reduced private spending, it said. Consumer spending in Asia has also been boosted in recent years by a world awash in liquidity in the decade following the global financial crisis. Central banks, led by the U.S. Federal Reserve, turned on the taps after credit seized up following the collapse of investment bank Lehman Brothers 10 years ago this month. Daiwa said that despite some marginal tightening in Asia, in the wake of Fed rate rises in recent years, the overall monetary policy environment remains loose. However, if global liquidity conditions tighten by more than expected, Asian economies are likely to see capital outflows, slow economic growth, and rising inflation, the report said, noting that households could possibly cut spending. That would be a particular problem for South Korea, Taiwan, Hong Kong, and Thailand, where households have resorted to heavy borrowing as higher interest rates would force them to tighten their belts, the report added. But Daiwa and others stress that authorities in Asia are ready to step in with stimulus to avoid any major downturns. The recent weakness in Chinese onshore domestic consumption might provide the opening for the government to initiate supportive policy action, in our view, UBS said in a report dated Tuesday, referring to authorities in Beijing. Trump's trade war with China is the biggest risk to the global economy. BlackRock Vice Chairman Philip Hildebrand describes the Federal Reserve's current pace of credit tightening as healthy and necessary. The policies that are embraced by the U.S. administration around trade represent the biggest risk today to the global economy, he says. President Donald Trump's trade policies pose the greatest threat to global economic growth, according to the vice chairman of the world's largest money manager. In an interview Tuesday, BlackRock's Philip Hildebrand also described the Federal Reserve's current pace of credit tightening as healthy and necessary. The U.S. Central Bank, which began tightening monetary policy in 2015, has raised rates twice this year and is widely expected to do so again this month and in December. A number of emerging market countries, including Argentina, Turkey, and Brazil, are feeling the impact as the Fed's monetary policy has boosted the dollar. When asked whether he believed Trump posed a bigger threat to the global economy than Fed Chairman Jerome Powell, Hildebrand replied, "I would say the policies that are embraced by the U.S. administration around trade represent the biggest risk today to the global economy." He added that the overarching difference for the Federal Reserve's current monetary strategy is the impact of the U.S.-China trade war. Can I disagree? Hildebrand's comments on CNBC's Squawk Box Europe come as investors continue to monitor the prospect of an escalating global trade war between the U.S. and China. Trump reportedly said over the weekend that he is prepared to impose tariffs on an additional $200 billion worth of imports from China as soon as a public comment period ends Thursday. Washington and Beijing have already applied charges to $50 billion of each other's goods in a tit-for-tat trade dispute. Can I disagree? Daniel Lakelly, chief economist at Tressis Gestion, told CNBC on Tuesday. The biggest threat to the economy is not Jerome Powell, and it is definitely not Donald Trump. The biggest threat to the economy is extremely loose monetary policies that have created these enormous bubbles. Lacalle argued that major central banks, including the Fed, were guilty of repeatedly misleading emerging market economies with empty promises. In response, Hildebrand said, "No central banker has ever said policy will never change. In fact, the Fed has been extremely transparent about its tightening path. It has been very consistent. We have a more challenging environment because of tightening, but that is normal," he added. "We have overarching risks around trade, and you have some very exposed countries. That is really the way we should look at this. US-China trade war, on exports. Explain which tariffs on key U.S. exports could have significantly adverse effect on the U.S. economy." Retaliatory tariffs have been levied on a wide range of products. China has identified over 500, and the EU, over 100 different ones. Some are frequently recurring. For example, whiskey has been targeted by China, Mexico, Turkey, and the EU. To the extent that these tariffs hurt U.S. producers of the products in question, all of them will adversely affect the economy to some extent. Whether that impact is significant for overall economic growth is another matter. Exports account for less than 5% of U.S. GDP, and the overall trade balance exports net of imports has been negative for decades, implying that the external sector has been a net drag on overall growth for a very long time. With that in mind, it doesn't seem like these retaliatory tariffs are going to make or break the U.S. business cycle. Explain which tariffs on key Chinese exports could have a significantly adverse effect on China's economy. The U.S. has applied tariffs to over 1,000 Chinese exports. While the external sector has tended to be a positive contribution to overall Chinese GDP, its importance as a driver of growth has significantly declined. Exports as a share of output have dropped to 7% this year from 10% as recently as 2011, for example. The current account as share of overall output is down to just 0.5% as of mid-2018, the lowest in at least 10 years. Perhaps most importantly, shifting the emphasis from external to domestically led growth has been conscious long-term policy push in China rather than a consequence of recent tensions. Here too then, tariffs will surely hurt certain individual industries, but they are unlikely to be a significant headwind for growth at large. Which commodities are most vulnerable in the U.S.-China trade dispute? Oil and other mineral fuels, metals, and soybeans are China's top raw material imports. To the extent that the ongoing trade dispute disrupts supply chains running from commodity producers through Chinese factories and to consumers of finished products in the U.S., the prices of these commodities may suffer. Countries reliant on these supply chains as an important contributor to growth may see adverse knock-on effects. To the extent that this encourages a division in their monetary policy stance, the associated currencies are likely to decline. One example of such a dynamic is the Australian dollar, which has weakened amid waning RBA Reserve Bank of Australia rate hike expectations. In 2018, China is Australia's largest external market, with iron ore and coal being the top commodities on offer. The U.S. stock market recently reached a peak of bull run, but lack of investor confidence persists. Explain. The benchmark S&P 500 index is near record highs, but trading volumes have looked diminished in the decade following the Great Recession relative to 10 years prior. Average volumes have held relatively unchanged since 2012, whereas in past recoveries steady price gains have seen a parallel rise in participation. Investors may be dubious considering world GDP growth hasn't budged from an average of about 3% since 2013. That is difficult to reconcile with record-high equities, which are meant to reflect expected earnings and thereby the global business cycle. Central bank stimulus may explain this disconnect. Years of rock-bottom interest rates and QE have driven down borrowing costs, encouraging investors to lever up and buy equities for the comparatively higher dividend yield. Policy tightening was always going to derail this strategy at some point, discouraging conviction. What is the potential impact of a full-blown U.S.-China trade war on global exports, and how might policymakers and businesses prepare? The main issue here is the duration of any large-scale trade spat between the world's top two economies. A lasting dispute that does long-term damage to the vast global supply chain network dependent on the U.S.-China commercial relationship will probably spill over into employment. That might depress global consumption levels in turn, undercutting the main engine of world GDP growth. For policymakers, this means having adequate cash on hand for a counter-cyclical fiscal policy response. Most central banks will find it hard to do the heavy lifting vis-a-vis stimulus, considering most have not meaningfully tightened since the crisis. For businesses, it means working to boost efficiency to the extent possible and maintaining generous capital buffers to weather a downturn in revenues. Such a scenario might be most attractive for investors, however, offering attractive bets in havens like the US dollar and anti-risk assets like the Japanese yen, amid the turmoil and subsequent opportunities for bargain hunting as asset valuations adjust lower.